Hi guys, this is Sia Jane and welcome back to my channel ACCA and beyond. So in this video we are going to be continuing with chapter number 10, which is procedures, and we are going to complete this chapter in this video. So yeah, let's begin where we left off, which is provisions and contingents. The rules are based on IAS 37. A provision is recognized when there is a present obligation from a past event, um, payment is probable, like which is more likely than not, and the amount can be reliably estimated. If payment is only possible, it is treated as a contingent liability and disclosed in the notes. For contingent assets, they are only recognized when receipt is virtually certain. If it is just probable, they are disclosed, and if only possible, they are ignored. When auditing provisions and contingent liabilities, the focus is on whether an obligation exists, whether payment is likely, and whether the amount is correctly valued. Completeness is key, as companies may understate liabilities to improve their financial position. For contingent assets, the focus is on existence, as companies may overstate them. Common examples include insurance claims or legal statements. Key procedures include obtaining a breakdown of provisions, checking calculations, and agreeing the amounts with the financial statements. The auditor must also should also confirm that a present obligation exists by reviewing documents or discussing with management. Board minutes can be inspected to assess whether payments is probable and whether the provision is appropriately recognized. Additional procedures are performed to ensure provisions are complete and correctly valued. The auditor recalculates the provision and agrees the components to supporting documents to confirm accuracy and completeness. Post-year end bank statements are also reviewed to check if any payments have been made, and they are compared with the provision to assess whether the estimate was reasonable. The financial statement disclosure are then reviewed to ensure compliance with IAS 37 and proper presentation. Finally, a written representation is obtained from management confirming that provision and contingent liabilities are complete, appropriately valued, and correctly treated in the financial statements. This provides additional assurance, although it is not a substitute for other audit evidence. For contingent assets, the auditor focuses on existence, valuation, and proper disclosure. Evidence is usually obtained from third parties such as lawyers, insurance companies, or insolvency practitioners. The auditor reviews correspondence to assess the likelihoods of receiving the amount and the expected value, and agrees this to the disclosure in the financial statements. If an amount has already been awarded, it should be matched to the receivables and income in the financial statements to ensure accuracy and proper recognition. Post year end Post-year-end bank statements are also reviewed to confirm whether any cash has actually been received. This helps verify existence, valuations, and rights to the asset. Overall, the aim is to ensure that contingent assets are neither overstated nor incorrectly recognized and are properly disclosed in line with accounting standards. IAS 501 requires auditors to specifically consider litigations and claims that could lead to material misstatements. This involves making inquiries of management, reviewing board minutes, and checking legal expenses accounts to identify any potential issues. A key area in auditing is क्या होगा? Is accounting estimates. These include provisions, depreciations, and receivable allowances. Estimates are inherently risky because they involve future outcomes and uh, rely on heavily on management judgment, which can introduce bias. Because of this, auditors must apply strong professional and skepticism when evaluating estimates. ISA 540 requires auditors to understand the entity and its environment, including regulatory requirements and financial reporting rules relevant to estimates. They must also assess internal controls over how estimates are made, reviewed, and updated, including management's review of past estimates. When assessing risk, auditors consider inherent risk and control risk separately. Inherent risk depends on how uncertain, complex, and subjective the estimate is, including the assumptions and methods used. The more judgment involved, the higher the risk of misstatement. Overall, the auditor's focus is on ensuring that accounting estimates are reasonable, unbiased, and supported by sufficient appropriate evidence. When when responding to risks in accounting estimates, the auditors perform key procedures to obtain reliable evidence. They obtain evidence from subsequent events to check whether later information supports or contradicts management's estimate. They also test how management arrived at the estimate, including the assumptions, methods, and data used. In some cases, the auditor may develop in their own point estimates or a range to compare against management's figure. Moving to share capital and reserves, these balances are material by nature. For share capital, key evidence includes the share register, share certificates, bank records, board minutes, and filings with regulatory authorities. Auditors agree authorized share capital and disclosure to legal documents and inspect bank records for for proceeds from share issues. Um, Board minutes are also reviewed to confirm the amount of share capital issued during the year. For dividends, evidence is obtained from board minutes, bank statements, and dividend warrants. The auditor checks that dividends declared, paid, and recorded are correctly authorized and properly disclosed in the financial statements. For directors' emoluments, the auditor uses multiple sources of evidence, includes um, sorry, multiple sources of evidence, including service contracts, payroll records, bank statements, board minutes, and written representation from management. A key procedure is to obtain a schedule of directors' remuneration split into wages, bonuses, benefits, and pensions, and agree to the financial statements disclosure. Payroll records are checked to verify wages, bonuses, and pension contributions, while bank statements confirm actual payments made to directors. Board payments are also reviewed to ensure bonuses and additional remunerations were properly authorized. Finally, written representations are obtained confirming that all directors' remuneration has been fully disclosed. For reserves, opening balances are agreed to the prior year and movements are reconciled. Any changes are verified using supporting documents such as valuation reports for evaluation reserves. Moving to the statement of profit or loss, mo- most companies rely on strong internal controls due to high volume of transactions. Auditors often rely on these controls and perform substantive analytical procedures alongside key tests of detail. Some evidence is also obtained indirectly through directional testing of related balances like receivables and payables. Uh, for revenue, the key assertions are completeness, cutoff, occurrence, and accuracy. Revenue must be re- Revenue must be completely recorded, recognized in the correct period, and only include valid sales at the correct amounts. To test cutoff, auditors inspect goods dispatch notes before the year end and trace them to the sales listing. Sorry, give me 1 second. Where was I? I guess to test cutoff, auditors inspect goods dispatch notes before and after year end and trace them to the sales listing to ensure correct period recognition. Since dispatch of goods usually indicates performance obligations are met, revenues can generally be recognized at that point. For accuracy, sales invoices are recalculated, including discounts and sales tax, to ensure amounts are correct. To test completeness, a sample of customer orders is traced through goods, dispatch notes, and invoices into the sales listing. For occurrence, credit notes issued after year end are reviewed and traced back to original invoices to ensure sales are properly reversed. Analytical procedures are also important. Revenue is compared with prior year and budgets to identify unusual movements. Gross profit margins are also reviewed to detect inconsistencies in cutoff, completeness, or accuracy. Overall, the aim is to ensure revenue is not overstated or understated and is properly recorded in the financial statements. For purchases and other expenses, the key assertions are completeness, cutoff, occurrence, accuracy, and classification. Purchases must be fully recorded, uh, recognized in the correct period, and correctly classified in the financial statements. To test cutoff, auditors inspect goods received notes before and after year end and trace them to the purchase listing to ensure they are recorded in the correct accounting period. Since ownership usually transfers when goods are received, the related expenses and liabilities should also be recorded at that point. For accuracy, purchase invoices are recalculated, including discounts and sales taxes, to ensure correct recording. To test completeness, a sample of purchase order is traced through goods received notes and invoices into the purchase listing. For occurrence and classifications, purchase invoices are inspected to confirm the goods relate to the business and are properly authorized and correctly classified. For analytical procedures on expenses, the auditor compares each expense category on year and against budgets to identify any unusual fluctuations. Significant variances are identified to assess possible issues with cutoff, accuracy, completeness, classification, or occurrence. Gross profit margin is also reviewed and compared with prior year figures to detect possible misstatements in purchases or revenue. Any significant movement is discussed with management to understand the underlying reason. Operating profit margin is similarly analyzed to identify inconsistencies that may indicate errors or recording or classification of expenses. Moving to payroll, the key assertions are completeness, accuracy, and occurrence. Payroll must include all genuine employees, exclude fictitious or former employees, and be correctly calculated. To test completeness, the total payroll expense is agreed to the general ledger and financial statements. Payroll listings are cast to verify mathematical accuracy, and employees' pay is recalculated. And for a sample using contracts, timesheets, and pay rates. Bank statements are also checked to confirm that payroll payments actually occur and match recorded amounts. For payroll testing, statutory deductions are recalculated to confirm that correct tax and social security deductions have been included in the payroll expense. This ensures accuracy. A sample of joiners and leavers is also selected, and the start and leaving dates are agreed to supporting documentation. The first and final pay packets are recalculated to ensure correct treatment, covering completeness, accuracy, and occurrence. For salaried employees, the total net pay per payroll record is agreed to the bank transfer listing and bank ledger account to confirm payments actually occurred. For cash wages, cash withdrawals are traced to wage payments, and any surplus cash is checked to ensure it has been correctly returned and recorded, confirming completeness and occurrence. The year-end tax liability is agreed to the payroll records, and subsequent payments are verified using post-year-end bank statements. For a sample of employees, payroll records are agreed to the personal files and timesheets to confirm accuracy. Analytical procedures include a proof and total calculations of wages and salaries, taking into account joiners, leavers, and pay changes, and comparing this to the financial statements to identify discrepancies. Year-on-year comparison of payroll are also performed, with any unusual fluctuations discussed with management to assess completeness. So, I guess this is the last topic. So, smaller entities have both advantages and disadvantages from an audit perspective. They usually operate similar business with lower inherent risk due to less complex transactions. Owners, managers often have strong direct control, which can improve oversight but also increase the risk of manipulation or personal use of business funds. Similarly, systems are generally simpler and less sophisticated, often with fewer IT controls, although manual errors may still occur depending on how the system is operated. In terms of evidence, the same audit principle apply regardless of size. The risk evidence relationship still holds. However, fewer transactions may mean less audit evidence is required, and a full substantive approach may sometimes be more efficient. There are also key problems in smaller entities. Management override is a major risk due to concentration of authority. Segregation of duties is often limited as controls rely heavily on owner review and authorization. Controls are also less formal, meaning auditors typically place less reliance on internal control systems and more on substantive testing. Um, for okay, we have more. Sorry. For not-for-profit organizations include charities and public sector entities where the main objective is not profit but social or philanthropic outcomes. These organizations do not have shareholders and therefore do not pay dividends. Instead of profit, any surplus or deficit is reported in the statement of financial activities. They also prepare a balance sheet, cash flow statement, and supporting notes to the financial statements. From an audit perspective, control risk can be higher in NFP organizations, especially smaller charities. This is often due to trustees being part time or volunteers who may not have sufficient time or expertise to oversee operation effectively. Segregation of duties is often weak because of limited staff members. Many organizations also rely on volunteers who may lack formal accounting knowledge or awareness of control importance. In addition, systems are often less formal, which can increase the risk of errors or control weaknesses. Overall, audits of not-for-profit organizations require careful attention to control limitations and increased reliance on substantive procedures. In not-for-profit organizations, income is often received through donations, many of which are not supported by formal documents like invoices or orders. This increases the risk of misappropriation, especially for cash donations. Grant income is another key area where funds are only received if specific conditions are met. If these conditions are not satisfied, the grant may become repayable, creating a risk that a liability is not recorded. Restricted funds are also important. These are donations given for a specific purpose, such as project or department, and must be separately disclosed in the financial statements. The auditors must ensure that the restricted and unrestricted funds are correctly identified and presented. Going concern can be more difficult to assess in NFP organizations, particularly charities dependent on voluntary donations. Income levels may fluctuate due to economic conditions or changes in public interest and donation trends. There may also be complex regulatory requirements governing how funds are used and reported, requiring specialist knowledge from the audit team. Despite these challenges, auditors must still obtain sufficient appropriate evidence using a mix of tests of control and substantive procedures. This includes inquiries, inspection, analytical procedures to ensure income is complete, accurate, and properly classified. In addition to the specific auditors, the same planning procedures apply to NFPs as for companies, but with some key differences. Materiality is often set at a lower level uh, due to higher inherent and control risk, which may result in more extensive testing. The audit team should also be carefully selected, ensuring team members who have relevant work experience in not for profit entities and an understanding of the applicable regulations and reporting requirements. If sufficient appropriate audit evidence cannot be obtained, the auditor may need to modify the audit opinion. Not for profit audits may also include additional reporting responsibilities beyond the financial statements. A value for money audit may be required to assess whether the organization is using resources effectively and efficiently. A regular audit may also be performed to ensure that expenditure complies with laws, regulations, and funding conditions. In some cases, auditors may also be required to report on performance indicators such as service delivery targets or waiting times. Overall, audits of not for profit organizations often go beyond financial reporting and include wider accountability and performance assessments. With this, we have completed chapter number 10, which is procedures. And if you like this video, please share it with your friends and help them also in their revision. And if you find my content useful, please like, share, and subscribe. And one more thing, I'm not sure about my speaking style or my speed of speaking. If you found it a bit too fast, please do leave me a suggestion in the comment section, like should I slow it down or anything else, or should I be more clear with my pronunciations. It would help me a lot. Yeah, so thank you so much for watching.